Ever found yourself contemplating whether to invest a lump sum or spread out your investments over time? It's a question that plagues many investors, from the novice dipping their toes into the financial pool for the first time, to the seasoned professional with years of experience under their belt. The decision between dollar-cost averaging and lump sum investing is more than just a fork in the road, it's a choice that could significantly impact your financial future. So what exactly are we talking about here? Let's break it down. Dollar-cost averaging, often abbreviated as DCA, is an investment strategy where you spread out your investments over a period of time. You buy a fixed dollar amount of a particular investment on a regular schedule, regardless of the price. Over time, this strategy can potentially reduce the impact of price volatility on the overall purchase. On the other hand, lump sum investing is just as it sounds. It involves investing a large amount of money all at once. The idea here is to take advantage of the potential for higher returns over the long term, as the market generally tends to rise over time. But which is better? DCA with its methodical, steady approach, spreading out the risk over time, or lump sum investing, with its bold, all-in strategy, banking on the long-term upward trend of the market? It's a common dilemma that investors face, and the answer isn't always clear-cut. Factors such as market conditions, risk tolerance, and individual financial goals can play a significant role in this decision. In the end, the choice between DCA and lump sum investing is not about picking a winner. It's about understanding your options and making the best decision for you, based on your unique circumstances and financial goals. Today, we unravel the mystery surrounding DCA and lump sum investing. Stay tuned. First off, let's delve into the concept of dollar-cost averaging, often abbreviated as DCA. It's a term you might have heard tossed around in financial circles, but what does it really mean? Well, in the simplest terms, DCA is an investment strategy that involves spreading out your investments over a period of time. Instead of putting all your money into a particular asset at once, you'd buy a fixed dollar amount of that asset at regular intervals, regardless of its price. Imagine it like this. You're at an auction, and instead of spending your entire budget on a single painting, you buy several different pieces over the course of several auctions. This way, you're not putting all your eggs in one basket, so to speak. So, why would someone choose to do this? Well, one of the main advantages of DCA is that it can help reduce the impact of volatility in the market. By spreading out your investments, you're less likely to be significantly affected by short-term price fluctuations. This can be particularly beneficial in a volatile market, where prices can swing wildly from day to day. However, like any investment strategy, DCA isn't without its potential drawbacks. One of the main criticisms of this approach is that it could potentially limit your returns. If the market is on a consistent upward trend, you might miss out on higher returns by not investing a lump sum at the beginning. Another potential downside is that it requires discipline and patience. It's not a strategy for those looking for quick returns. Instead, it's a long-term game plan, designed to reduce risk and potentially provide steady, albeit potentially slower, growth over time. In essence, DCA is a strategy that plays it safe, reducing risk but also potentially limiting rewards. It's not for everyone, but for those who prefer a slower, more methodical approach to investing, it can be a viable and effective strategy. Now let's shift gears and examine the lump sum investing strategy. Think of lump sum investing as diving headfirst into the deep end of the pool. In this approach, an investor takes a large sum of money and invests it all at once into a particular asset or portfolio. It's essentially about making a significant financial commitment up front, instead of spreading it out over time. Let's say you've just inherited a large sum of money, or received a hefty bonus at work. With lump sum investing, you'd put all of this money into an investment immediately. This strategy is based on the principle that the market tends to go up over time. So, the sooner you get your money into the market, the longer it has to grow. But what makes the lump sum approach appealing? Well, one of the main advantages is the potential for higher returns. Since you're investing a large amount all at once, you have more capital working for you from the get-go. If the market performs well, your entire investment benefits, and your returns could be significantly higher than if you'd invested smaller amounts over a longer period. However, as with any investment strategy, the lump sum approach does come with its own set of risks. The main one being market volatility. If the market takes a downturn shortly after you've invested your lump sum, your portfolio could take a significant hit. This strategy requires a certain level of risk tolerance and the financial ability to weather market downturns. Moreover, the lump sum approach also assumes that you have a large sum of money available to invest up front, which may not be a feasible option for everyone. In essence, lump sum investing is like a high-stakes poker game. It can deliver big wins, but it also requires a strong stomach and a steady hand. It's an approach that demands both financial readiness and emotional resilience. So, lump sum investing can be seen as the more daring approach, potentially yielding higher returns, but also posing a greater risk. Having understood both strategies, it's time to pit DCA against lump sum. Let's delve into the intricacies of these two investment approaches and see how they stack up against each other. First, let's consider volatility. In a volatile market, dollar cost averaging could be your best friend. By investing a fixed amount at regular intervals, you're buying more shares when prices are low and fewer when they're high. This can help mitigate the impact of short-term price fluctuations. On the flip side, if the market is on a consistent upward trajectory, a lump sum approach could yield higher returns. By investing all your money at once, you're giving your investment the maximum amount of time to grow. Now let's talk about risk. With DCA, your risk is spread out over time. You're not putting all your eggs in one basket at a single point in time. This approach can be particularly appealing if you're risk-averse or if you're new to investing. However, the lump sum approach isn't without its merits. If you have a large sum of money at your disposal and you're confident in your investment choice, it can make sense to invest it all at once. This approach can potentially bring in more profits in the long run, especially in a bullish market. Now let's address a common misconception. Some people believe that DCA always outperforms lump sum. This is not necessarily true. The performance of each strategy can vary greatly depending on market conditions and timing. Similarly, it's a myth that lump sum is inherently more risky than DCA. The risk level of each strategy depends on several factors, including your financial situation, your investment horizon, and the specific investments you choose. As we can see, the choice between DCA and lump sum comes down to one's individual circumstances, risk tolerance, and investment goals. There's no one-size-fits-all answer. The best strategy for you depends on your unique situation and your personal financial goals. So, which strategy wins the DCA versus lump sum battle? Well, the answer isn't as clear-cut as you might think. Let's take a step back and consider the key points we've discussed. Dollar cost averaging, or DCA, is a strategy that involves investing a fixed amount of money at regular intervals. This method can be beneficial in volatile markets because it reduces the risk of making a large investment at an unfavorable time. However, it does require discipline and a long-term commitment, which might not suit everyone's lifestyle or financial situation. On the other hand, the lump sum approach involves investing all available funds at once. This strategy can potentially yield higher returns if the market is on an upward trend, but it also carries the risk of entering the market at a peak, which could result in significant losses if prices fall. So who emerges victorious in this financial face-off? Well, it's not about declaring a winner. It's about understanding the pros and cons of each strategy and determining which one aligns with your financial goals, risk tolerance, and personal circumstances. For some, the systematic approach of DCA might provide peace of mind and a sense of control. For others, the potential for higher returns with a lump sum investment might be more appealing. The important thing to remember is that there's no one-size-fits-all answer to investing. What works for one person might not work for another. It's about finding a strategy that suits your individual needs and sticking to it. In conclusion, whether you choose DCA or lump sum, both strategies have their merits. Your choice should reflect your comfort with risk, the time you have to invest, and your financial goals. Remember, the best investment strategy is the one that aligns with your financial goals and risk tolerance. As always, make informed decisions and consider seeking advice from a financial advisor. Thanks for watching, and until next time, stay financially savvy.